Welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, owner, and founder of Menninger and Associates Financial Planning. I'm pleased to have with me as my guest again, Brad Sorensen, a chartered financial analyst from Cornerstone Portfolio Research. Thank you again for joining me, Brad.
Thanks for having me. Glad to be here.
So this is the second episode. Episode one was to discuss what happened in Q2, which was absolutely phenomenal, better than 20% gains in the markets. And that even included a 7% loss in June. So we talked about that and what caused it. A lot of it was associated with the Straits of Hormuz and the oil, et cetera, et cetera. And we talked about the concern of inflation, which has a lot to do with why June went down. But now the Straits of Hormuz are open-ish, okay? And we also reported extraordinary earnings in April of the quarter, which is what helped propel the markets because, expectations of 16% and all of a sudden they pull out 22 or 23%. That is just remarkable. So anyway, that's what we talked about in the first episode. What we're going to talk about today is a little bit more, where are we now? And a good place to start, I would imagine, is, and mind you, just, today is July 2nd, so this isn't going to air until somewhere around the 12th or the 8th or whatever the day is. What I want to talk about now is actually it's going to air on the 15th. But where are we now? And today, the labor market just reported jobs for June, which, this is the old good news is bad news, but it piggybacks where we left off on the prior episode when we were talking about the Fed potentially raising rates, where it went from cutting rates to raising rates. The jobs report came in not bad, but less than expected. So let's talk about the current economy, because let's go with, we've had really strong jobs reports this whole year, and the month of June was not as robust. Talk to us about the jobs, the labor market.
Yeah, so it's interesting. There's a lot of factors going on, but the labor report, it came in a little soft on the headline number. And a lot of people don't know this. There are actually two reports within the labor report. There's the headline number, which is how many jobs were added, and that was below expectations, 57,000 versus 115,000. And the previous 2 months were revised lower by 74,000. And then there's the unemployment rate, which is actually a different whole survey. People think they just flow through each other. No, they're two completely different surveys. And that actually fell from 4.3 to 4.2%. Why is that? Well, there's a lot of reasons, but one of them is the participation rate fell to 61.5%, which is the lowest level since 2020. So that is a lot of people retiring. Baby boomers are retiring. The immigration situation, there's fewer immigrants in the United States looking for jobs. So the participation rate has fallen. So the unemployment rate is still historically low, 4.2%. So where does that leave the job market? Well, the phrase I would use is solid right now. We see unemployment claims. That's where people file for unemployment. That's a leading indicator because people will start laying off people, and that's where we see it first. And that has remained historically low. It hasn't shown any rise. So we may just be in this environment where there are fewer workers stay in their jobs, and the additional jobs that we add now that we've recovered from the COVID situation are more in the 50 to 100,000 job a month range than the 150 to 200,000 that people got used to following COVID. Well, there's not that desperate need for employees that we saw back then, and the employers are a little more hesitant to hire right now because of AI, but the unemployment rate, but they're not firing people to a large extent. So the job market solid. And today, just the last thing, you mentioned the Fed. So yeah, this is how things change. The chance of a hike at the next Fed meeting dropped by 10% because of this jobs number. One number can have a big impact on what the market thinks the Fed is going to do. And so the odds of a hike decreased. And actually, that's one thing War said. I don't want, one, you mentioned it. He said, I don't want bad news to be good news and good news to be bad news. I want good to be good and bad to be bad. So I don't know how he'll accomplish that, but he's working on that.
It annoys me. Yeah, I've always said that it absolutely annoys me when bad news is good news.
Well, it annoys Kevin too.
Well, that's good. I'm glad he and I are on the same page. I'll have to just let him know that I appreciate his thoughts on that. So, but you in our conversations, because we talk every week, is you had said that the Fed dropping rates or raising rates aren't necessarily going to cure the current inflation that may be driven by oil. So why explain that?
Yeah, and that's where I think there's a lot of discussions in there because they have kind of blunt tools to use. And you know, typically what happens is they'll raise rates, the cost of borrowing money will go up, and that will reduce the amount of money flowing through the economy, which will slow down the economy. Makes sense. But what's causing inflation right now? Well, oil is a lot of it. Well, is raising rates suddenly going to produce a lot more oil? Well, no, that's not going to help that. Actually, it may help reduce the demand for oil, which may reduce. So that's what they have to talk through. But that's why these tools, and then we've seen, another factor in inflation is actually semiconductors, which we talked about in the last episode. Like Apple announced they're going to have to raise the prices of a lot of their products because semiconductors, the little chips inside almost everything we have, the demand of them is so great that they're having to raise prices on them. Well, is that demand going to slow down if the Fed hikes by one or two, 25 or 50 basis points? It's hard to imagine. And then, as Mr. Warsh, he's often mentioned, how much efficiencies does AI start to bring, which will bring down inflation? So this is if you want to be a Fed person, some people think they can do it. This is the discussions they have in the meeting, and they have a lot of economists doing it, and they fight about because there's a lot of different views on how that can turn out. But that's why there's a little uncertainty right now, and we've gone from expecting cuts to expecting hikes to now just slightly expecting hikes. So it can change pretty quickly.
Well, we referenced in a previous episode the 800-pound gorilla being the Straits of Hormuz. We still have the 600-pound gorilla in the room that got masked by the 800-pound gorilla, but now that 800-pound gorilla seems to be leaving the room, and the 600-pound gorilla is AI. Okay, and I remember there being a period, and I don't remember when it was, but it wasn't that long ago, that a lot of your software companies got smoked. The Microsofts, the Palantirs, anybody associated with software got killed because a report came out and said AI is going to be able to do what they do. The legal profession, they got smoked because AI can do what they're going to do or what they do. And so now all of a sudden, they're, well, maybe not. And then AI, the always concern is, well, it's going to replace the worker. Well, maybe not, because now you're going to have a shift where you're going to need people to do the things that AI needs. You got to have people making the semiconductors. You got to have different people. So talk about all of the nuances associated with AI and its impacts on the economy, because some of it's really good, some of it's concerning, and some of it I think is still left unknown. In fact, of all of it, I think more of it is unknown.
Well, Mike, you have a good way of bringing up a topic that could take about 4 hours to talk about, and you expect me to address it in 3 minutes. So
No, not 30 minutes, 4 minutes.
I just love when people are listening to this, they're going to say, he just asked him to explain all the pluses and minuses of AI. How long is this episode that I'm going to be listening to? Yeah, just briefly. Um, we've gone from, you hear both, it seems like they're extremes, that AI is the greatest thing in the world and it's going to produce these efficiencies and people are going to thrive, and to it's going to destroy the world. Well, a lot of times when there's two extremes, the middle is really where you want to hang out. And I think that's what we're starting to see. People are realizing that no, you can't just lay off every person that's out there and replace them with AI. You need human intervention. People want to deal with humans. AI can make mistakes. You need humans to check over it. And the software companies, for example, have recovered. A lot of the legal and financial professions have recovered because people don't want to turn everything over to AI. Now, over time, that might change, but it's going to be a gradual process as we shift into using more AI getting better, those kind of things. So I think the market has become a little more comfortable with that, and what we're watching now is the spending on advancing, especially the generative, the open AIs, the Anthropics, the Googles, their main models. There's kind of a race to become the dominant one. So they continue to spend and spend and spend. And now investors are wondering what is the point of that? When do we start to make money off of that? So those are the questions. But we're seeing that AI is not just that. A lot of people think of like ChatGPT as or Claude as AI, but there are a lot of other things it can do. It can make, there's already cases. I've looked at companies there they can digest data from health results a lot quicker and extreme and bring in results from all over the world to help develop new drugs and can make manufacturing more efficient. So there's these, specific AIs that can just make certain functions work better. And that's where it's being seen. But we're not seeing huge layoffs because you still need people to watch over it.
Well, there's a lot of things that AI can do. And to your point, I thought the medical profession was one of it. It's the ability to take data that the human can't do as quick as the computers. But the reality of it is that you got to teach the computer to do it. And to your also point earlier is I've had AI do writing articles and things like that for me to start. I look at it and I'm like, holy smokes, this is wrong. Okay. And you have to adjust it and make adjustments. And what I also see as a problem with AI is in academics. You know, how many kids are going to cheat by having the computer write a program? And there are apparently people who can tell it was actually written by AI and not written by the individual. Like, all right, well, that's a very interesting thing. But AI is a very interesting concept. And I think it reminds me, and we've had these discussions many times before with you as well as Thomas, who's the leader of your organization, is AI is here to stay. And it reminds me of the internet. Okay, when the internet first came out, invented by Al Gore, uh, when the internet first came out, it was an avenue to do things. Well, that's what AI is going to be. And we haven't really figured out exactly what it's going to do, who's going to necessarily benefit more than others. And to your point, how do you monetize it? And I remember the very beginning, somebody said, should we invest in Facebook? I'm like, okay, how's Facebook going to make its money? I mean, all it's doing is it's connecting me to my high school friends and stuff like that. How does it make money? Well, they figured it out, advertising, et cetera, et cetera. So the odds are they're going to figure out how they do that. But there's a lot of different impacts that it's having. And to an ancillary perspective, to your point, is you have companies out there who are going to be able to operate way more efficiently. Okay, not necessarily replacing jobs, but operating way more efficiently. So there's a lot of benefits that AI is going to produce, but I don't think we really know yet what they're all going to be.
No, we certainly don't. And as you said, we're filming this on July 2nd, and I don't want to get too rah America, but do love America. And that betting against America, like you said, the internet, you look back to what it started as and to what it is now, and all the things people have been able to use it to make money on, like you mentioned with Facebook, and there's a million other examples. So that's why Americans will figure out how to make money off of the open AI and AI systems and how to use it efficiently and well to benefit the public. And I think that's what investors are starting to realize as well.
To your point earlier, there's a race to be number one. Um, I would imagine from a national security perspective, there's a race to make sure that we're ahead of other competing countries, specifically China. We want to make sure that we're the ones that develop and figure out all this stuff before they do.
Yeah, that's the tough part, that a lot of people want to put limits on what AI can do and slow roll this stuff out, but China's not interested in doing that. So it's kind of like, well, if we do it, even Americans can use what DeepSeek, which is kind of China's main AI situation. So that's a conversation that's ongoing, and leaders have to deal with, and government leaders have to deal with. And it's a tough game to play, but you don't want to be overly restrictive because you'll get burned. And we've seen what government regulation can do to a lot of industries.
It's funny you referenced to DeepSeek. It's just another example of investor knee-jerk reactions. I don't remember what it was, when it was. I'll say when. It's probably about 6 months ago. The concept of DeepSeek coming out, and all of the AI got smoked. And then all of a sudden, it's not an issue anymore.
Yeah, just really quick. That's because DeepSeek, they said, here's a great AI. It's compatible with Chat GPT, and they did for pennies on the dollar. Well, they lie. So China lies. So investors go, oh, yeah, they lie. Remember, everybody has to be reminded of that they steal and they lie. They steal technology and they lie about it. So whether that's, I hope that's not too controversial. That's the way they do things, and they usually admit it.
That's a good breaking point, because what we'll do is we'll pick up about other facets of the economy on the second portion of this segment. So stay tuned. We'll be back with you in a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger & Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained, and we're wrapping up the segment with discussing other factors of what's going on in the economy. There's some things that's now coming up, which I don't know why it hasn't really been discussed more often, but we talk about it every week, every month, every year for the last several years. And I know I talk about it as it pertains to taxes. Okay. We're in the lowest income tax bracket system that we've ever been in. And part of that is because we spend $7 trillion, we bring in 5. What's the fix? We just borrow the other 2. How do you do that? We just add to the national debt. That's a problem, okay? And by the sound of it, it's starting to come around. Investors are saying, hey, government, when are we going to start paying attention to the deficit? And when are we going to start paying attention to our national debt? Because, and I remember this vividly because I used to present this when I was doing a variety of different tax things. It wasn't that long ago, in 2020, that the interest that we're paying on our debt was only 6%. Now it's over 13 and is over $1 trillion of our $7 trillion nut is interest on the debt, just the interest without paying it down. Anyway, talk about what's going on as far as investor sentiment on that topic.
Well, it's interesting. The brilliant phrase that economists use, and Wall Street people too, is it's not a problem until it's a problem. Boy, that's helpful. So, and we've seen that, though. You mentioned it previously, that we saw the dollar weaken. And one of the reasons we saw that was caused international outperformance, or helped international outperformance. We saw that last year. And that was because of increasing concerns about the US deficit and whether foreigners would still finance it by buying treasuries. And there was rumors that they wouldn't. But and we saw interest rates start to spike, but every time we get the 10-year close to 5, it goes back down. So what used to be called and it's still called the bond vigilantes. That's who kind of the general term for people in the fixed income market that will start to riot a little bit when the deficit gets out of hand. They've started to do that a few times over the past year, and then it's been short circuited by one thing or another. So that's still out there, and there's no plan to address it. There's been reports out there that like Social Security is going to run dry and they're going to have to not pay all their benefits much sooner than previously thought. Those kind of things are out there. It doesn't seem like Congress is going to do anything about that. And the market isn't worried about that right now. And somewhat for good reason, because we've learned that Congress doesn't do anything until it has to do something. And then it usually does. But there is a chance that that's one of the risks we see, that the borrowing costs for the United States will get higher, which raises the cost of all financing in the United States. So that is a risk out there with the kind of deficits that we're running.
Well, not to mention that it's the first time since World War II that the U.S. debt has exceeded our GDP.
Yeah. And that was a point that raised some eyebrows. And there's the other thing, that there was actually hope, and President Trump had kind of mentioned this, that the Federal Reserve could finance the debt by buying the treasuries, because they have that ability and they bought treasuries before back, and they still are refinancing into those treasuries because their balance sheet is pretty high. But now with Chairman Warsh there, he said he wants to decrease that balance sheet. So that's unlikely to happen. So that will also increase the pressure on the deficit to continue to sell those treasuries to finance the deficit. So we'll just see how the market absorbs those. So far, it's been okay. And that's one place we look for like the interest rates start to spike, because Chinese investors or European investors start to not want that debt.
So for the viewers and the listeners, when we're saying that the debt exceeds GDP, it would be like me saying to you, your income is 100,000, but the amount that you got sitting on credit card is also 100,000. Might that be a financial problem waiting to happen? And your debt's growing faster than your income is. Might that be a problem? No kidding.
That will be a problem. We just don't know when. And there's a belief that we can grow out of it, and we can. But in order to do that, we have to reduce spending to some degree. And everybody wants to reduce spending until they find out it's something that they care about.
Right.
And all that spending goes to someone in the United States. So there's always somebody protesting that cut in spending.
Such as the specific congressman. Hey, I'll pass this bill if you give me this little pork inside that bill.
Yep.
And that's what goes on in Congress, which drives me batty. And the reality of it is that is a giant gap. So a giant gap of 7 trillion to 5 trillion, round numbers, means you'd have to cut spending by an enormous amount or raise taxes by an enormous amount. And if you raise taxes by an enormous amount, you're cutting the ability for people to be able to spend, because you're taking their money away. You cut the spending, watch how quickly, since 68% or almost 70% of the US economy is consumer spending. So that's a problem that just is getting worse, but I'm always concerned that it might be a runaway train. But
and we get into tax policy, and we've seen it though that raising taxes usually doesn't equate to a 1-to-1 revenue raise. And what raising taxes does, it just gives Congress license to spend more. So I'm not really gonna raise taxes, but you can see the population that moves out of high tax states into low tax states, what that does. So yeah, they're going to have to somehow address this, and we can, cut some spending, grow our way out of it. But eventually they're going to have to do something, and investors will force them to do something. But for right now, they're pretty ambivalent about it.
So that leads us into the next topic, which is the consumer. And, as I pointed out, it's somewhere between 68 and 70% of the U.S. economy is based on consumer spending. But to your point, two things: consumer sentiment is down because they're afraid. But as you also have pointed out on numerous occasions, that doesn't cause them to stop spending.
No, it's a great thing about Americans. And we've seen it. I think that as Europeans have come over for the World Cup, they've mentioned it that Americans just seem optimistic. And that's even if they're feeling bad, they spend money because that's what makes them feel better. And if they feel good, they spend money because they're feeling good. So I really don't. You'll see the media headlines, the consumer sentiment at a 5-year low or whatever because of Iran, because of things the president is doing, because of gas prices, et cetera, et cetera. And yeah, they may be feeling bad, but you look at the spending and retail sales continue to be good. Target, Walmart, those big retailers, I'm not recommending their stocks or not, but I'm just saying the retailers are producing good results as people continue to spend money there. Now, it is true with inflation, the bottom income people are struggling, and that's unfortunate. And the Fed's talked about that. But just realistically, it's not those people that drive the economy. It's the middle income and up that do, and they continue to spend money.
Well, and there's another sort of ancillary to that is sometimes when the economy is doing poorly, you'll find the likes of the Walmarts and the Targets do better. Why? Because those shoppers who used to shop at Macy's and JCPenney, which may not be around anymore, are now saying, hey, you know what? I can't afford that. Let me go to Walmart or Target. So it's not always the greatest, but to your point, consumer continues to spend, and we can always rely on the consumer. Go consumer.
Well, yeah, and the whole world knows that. That's why everybody wants access to the U.S. markets, because the U.S. consumer is the biggest spender in the world. And that helps us. It puts a lot of people in debt, but it helps our economy.
Yep. So what we'll close out on, because it serves as a great shoe-in for the next episode, is talking about stock valuations. You had told me what that is, the PE ratio. And the PE ratio is basically how much you're paying for the stock and what is it earning. You know, if a stock price is $100 a share and it's earning $5 a share per year, its PE ratio is simply 100 divided by 5, which is 20. The long-term historical average of the S&P 500 is roughly 16 or 17, okay? But it's down from where it was earlier in the year. Talk about that a little bit real quick.
Yeah, this is interesting. And this is something that they always focus on the price, that if prices come down, valuations come down. But like you said, there's an E component for that. So the E, the denominator, if you think back to your junior high algebra, if the E goes up, that can also reduce the PE. So that's a lot what we've seen to begin the year, like the Mag 7, for example. Let's go see the broader S&P 500. Its PE ratio was about 23. So that's forward looking. So based on forward earnings estimates, it was trading at 23 times. Now the stock market's gone up, as we've shown before. S&P is up 10, 12% this point in the year, but the PE's gone down to close to 20. So why is that? Well, because as we mentioned earlier, first quarter earnings were so great that, and we'll talk about this more later, but just a month ago, expectations for second quarter earnings were about 18%, and now they're up to 23% year over year growth. So the earnings are growing so much that it's bringing down the PEs, even though the prices continue to go up, earnings are going up more.
That's a very favorable thing. And that's even the Mag 7. The Mag 7, you hear a lot of people say, my goodness, they've gone up 2, 3, 4 times in the last 2 or 3 years. That's just unprecedented growth. They're overvalued. I hear that all the time. Overvalued. Well, the practicality of the matter is that your PE ratio is based on the projection of the future. And you got the likes of NVIDIA, for instance, I think was posting like 80% growth That's just out of this world. So if the stock did not grow by 80% over the last year, but its earnings grew by 80%, its PE ratio is coming down. And the Mag 7 PE ratio that you said at the beginning of the year was 33, and now it's at 23. That's
Yeah, and that
arguably
just shows that their earnings have gone up, the prices and some of them have come down. But this is what, and people compare them, and there are a lot of comparisons, but this is the major difference between the late 1990s internet era bubble and now. And I'm not saying there's not some stocks out there that are bubble-ish, but there were earnings with a lot of those stocks. The E was zero, so they couldn't have the PE ratio of the Nasdaq got to in the 40s, and with a lot of stocks not even having a PE ratio. Now we have the stocks that are the high flyers, they have massive earnings, and that helps support the valuations. Now they still might be a little overvalued, but they have the earnings support under them to support a lot of that valuation.
Well, yeah, I mean, look at what's happening every quarter. You're like, yeah, okay, 50% growth. Boom, it comes out with 60. You're like, holy smokes, how in the world? And to your point that you've been saying for a long time, and I'm not knocking you on this, it's like, this is unsustainable, but gosh darn it, it keeps doing it. It's got to come to an end. You cannot grow by 50% per year, every year, forever.
You can't, and they won't. But that's also why investors are starting to look to other areas, and that's healthy because, yeah, you can't keep growing at this. This is a lot of large numbers. You can't keep growing at that rate, and they won't. But they'll still keep growing and at a decent rate, and other companies are also growing. So let's move some money over there.
It's a beautiful thing. So that valuation is a great lead in, a great place to end here. And we'll probably pick up from exactly the same place on our next episode. We're going to be doing a look ahead. So, Brad, thank you very much for joining us again. Very insightful. And thank you to the viewers and the listeners. Delighted to bring this to you. Love bringing Brad in every quarter. Brings common sense to the concept of the markets and the economy, because always believe in it's the economy, stupid, right? It's the economy drives the markets. If the economy is stinking up the joint, the markets aren't going to be doing very well. If the economy is really strong, the markets will be doing well, even though in theory, markets are considered to be a leading indicator, but I'll leave it at that. The two are obviously related. So thank you for joining us. I hope you got something out of each of the last two episodes, and you have a wonderful day and a wonderful week, and we'll catch you next time on Financial Planning Explained. Thank you.